Imagine waking up one morning, logging in your savings account and seeing this. Balance zero. Your hard-earned money gone. No warning, no safety net, just vanished. Sounds impossible, right? Well, it's already happening to thousands of people who trusted the wrong companies with their money. And here's the scary part. The very banks we've relied on for decades aren't as safe as they used to be. And fintech startups, they're even worse, often operating without the traditional safeguards that protect your savings. If you've been chasing high yields or putting your savings into flashy new apps without asking the hard questions, you're playing with fire. And in today's uncertain financial system, that fire could burn everything you've worked so hard for. But it's not too late. In this video, I'll show you how to protect yourself, avoid the biggest traps, and keep your money safe no matter what happens next. Hi, I'm Noel Lorenzana. I'm a CPA and I care about you and keeping your money safe. So why am I saying that banks are shaky? Let's start with the facts. Over the past few years, we've seen rising interest rates and growing economic uncertainty. These shifts have put serious pressure on the banking sector. And here's the thing. Many banks are sitting on massive unrealized losses in bonds and commercial real estate. If those losses were to be realized, it could trigger a wave of banking problems. Now, even though most large banks are regulated and backed by the FDIC, not all banks are created equal. Smaller and regional banks often don't have the same level of stability, and if a major recession hits, things could unravel quickly. But here's the real risk. Fintech companies. While traditional banks, even the vulnerable ones, operate under strict regulations and offer FDIC insurance, fintech startups don't always play by those same rules. These companies aren't real banks. They're often middlemen promising high returns, flashy perks, and big bonuses to lure you in. But here's the catch, without the same protections. If these fintechs go under, your money could disappear. And unlike banks, there may be no safety net to fall back on. Take what just happened with Synapse, a fintech company that recently went bankrupt, freezing thousands of accounts and leaving people unable to access their savings. Or Yotta, where people trusted a flashy new app only to discover that their money wasn't as secure as they once thought. More on this in a bit. Here's the cold hard truth though. When you chase high yields in today's financial landscape, you're taking on risks that could leave you broke. And trust me, the flashy promises of fintech startups often hide massive red flags. Let's talk about some of those. Let's talk about the red flags, the warning signs that scream, stay away. If you're considering putting your money into a fintech startup, these are the things you absolutely must look out for. Number one, unproven track record. First up, the company's age. Many of these startups haven't been around long enough to build a solid reputation. Synapse, for example, was just a few years old when it collapsed, leaving customers stranded. And Yotta, launched in 2020, it was barely out of its infancy when people started trusting it with their life savings. Here's my rule of thumb. If a financial institution hasn't been around for at least a decade, proving it can survive good times and bad, I'm not putting my money there, period. 2, unsustainable high yield. Next, let's talk about those tempting high yields. If a fintech company is offering you way above market rate, say 5% when everyone else is offering you 2.5%, you need to ask yourself, how are they paying for this? Chances are they're taking on massive risks or pulling funds from unsustainable sources to keep those returns flowing. It's like borrowing from Peter to pay Paul. It's just not sustainable. Remember this, if it sounds too good to be true, then it probably is. 3, lack of transparency. Another huge red flag is a lack of transparency. Where is your money actually being held? Who's backing it? Many fintech companies aren't banks themselves. They park your money with partner banks. And if that bank fails, you could be out of luck. Always dig into the details. Verify that your deposits are actually FDIC insured and that you know exactly who's holding your money. If a company makes it hard to find this information, then you might want to take a pass. 4. Over-the-top promises or gimmicks. Watch out for gimmicks. Some companies try to distract you with flashy perks like prize giveaways, referral bonuses, or even luxury car drawings. But let me ask you this. If a company has to dangle a Tesla in front of you to earn your trust, are they really a safe place to park your savings? These marketing tactics are designed to get you hooked without asking the tough questions. Don't fall for it. Now that we've covered the red flags to watch out for, let's take a moment to look at a sobering, real-world example that's making headlines right now. This isn't just theory, it's happening to thousands of people as we speak. Let me tell you a story from the CNBC article, a story that thousands of Americans are living through right now. Kayla Morris, a former teacher from Texas, spent 15 years saving every dollar she could for her family. When she and her husband sold their house, they trusted a savings app called Yotta to keep their $280,000 safe. But earlier this year, Kayla found out that she couldn't access her account. Months later, she learned that out of her $280,000, she'd only be getting $500 back. That's right, just $500. And Kayla isn't alone. Thousands of other Yotta users have seen their savings vanish after a behind-the-scenes fintech middleman called Synapse collapsed. Synapse worked with apps like Yotta, connecting them to real banks like Evolve Bank and Trust. But when Synapse filed for bankruptcy, everything fell apart. Up to $96 million in customer funds went missing, and the banks involved couldn't figure out where the money went. One customer, Zach Jacobs, lost over $94,000. Another, Andrew Malone, got back just $5 from a $200,000 deposit. And they're not gamblers or risk takers. Like so many others, they believed their money was safe in accounts advertised as FDIC insured. But here's the truth. These fintech companies and their banking partners relied on complicated, fragile systems that fell apart under pressure. Customers didn't have a direct relationship with the banks holding their money, and when the system broke, there was no one to step in to fix it. People like Zach Jacobs have formed groups to fight back, calling this a reverse bank robbery. But here's the heartbreaking reality. Most of these customers will never see their money again. This isn't just about Yotta or Synapse, it's about the risks of putting your money into systems that none of us fully understand. Systems that aren't built to protect you when things go wrong. And if it can happen to Kayla, Zach, and Andrew, it can happen to anyone. By the way, I believe Bitcoin and other cryptocurrencies could be one of these risky financial systems. I've shared my thoughts in a video linked right up here. Let's talk about what we can learn from this and how you can make sure your money is never at risk like this again. In today's uncertain financial climate, it's not about chasing big returns. It's about keeping what you have safe. Here are the steps you need to take right now to protect your savings and preserve your wealth. 1, stick with proven institutions. First and foremost, stick with institutions that have stood the test of time. If a company hasn't been around for a decade or more, or doesn't have a strong track record, it's just not worth the gamble. For now, I like to think of the big banks as too big to fail, meaning the government would likely bail them out if ever needed. Sure, these banks might not offer the flashiest perks or even the best rates, but they come with something far more important: stability and regulation. 2, verify FDIC insurance. Always, and I mean always, verify that your deposits are directly FDIC insured. If a fintech company uses an intermediary that is not FDIC insured, then your deposits may not be covered. The intermediary's account might have FDIC insurance, but that coverage doesn't extend to you unless you're recognized as the FDIC's direct banking customer. To ensure your deposits are protected, you need to confirm that you have a direct relationship with an FDIC insured bank. This is your safety net if the worst happens. Just because a fintech says your money is insured doesn't mean it actually is. If you can't confirm this, don't risk it. It's that simple. 3, diversify where you store your money. Don't keep all your eggs in one basket. Diversify where you store your money. Keep some in a traditional bank, consider a credit union, and maybe even hold some in safer investments like T-bills. Diversification isn't just for investments, it's a key strategy for protecting your cash. 4, focus on wealth preservation, not high returns. In these uncertain times, wealth preservation should be your number one goal. Forget the 6 or 7% yields that sound too good to be true. Focus on keeping your money secure, even if it means settling for a lower return. Think of it this way. What's the point of chasing high returns if you could lose everything in the process? I always like to say that slow and steady wins the race, especially when it comes to financial stability. 5, do your homework. Always do your due diligence. Before trusting any financial company, dig into their history, read a lot of their reviews, and understand their business model. If something feels off or is too complicated or you just don't understand it, trust your gut and walk away. Your money is too important to leave to chance. Take the time to do the research. By following these steps, you're not just protecting your savings, you're giving yourself peace of mind in a time when so much feels uncertain. My goal isn't to scare you, it's to empower you, because the more you know, the better equipped you'll be to navigate these uncertain times. I'd love to hear your thoughts. Do you think these fintech banking solutions are safe, or am I just being overly cautious? Let me know in the comments below, and if you found this video helpful, please hit the like button and subscribe, because I've got more tips to safeguard your finances and navigate today's complex economy. Remember, it's not about chasing returns, it's about keeping what you've worked so hard to earn. Thanks for watching, and see you in another video.